Best tech dividend stocks is the topic of today's presentation. And before we get into that, I wanted to touch on the topic of oxymorons. Now, half of our audience hails from across the globe, and they may not know who this gentleman is. Well, he's a famous American philosopher who coined terms such as think about how stupid the average person is and then realize that half of them are dumber than that. So George Carlin said a lot of interesting things. For example, oxymorons, he pointed out military intelligence, jumbo shrimp, near miss. That makes no sense. So if two planes nearly missed, then that means that they came close to missing and they should have hit each other, but that's not how we use that term. Cautiously optimistic, we use this one here at Nanalyze. I'm not sure if that came from Mr. Carlin or not. A 12-ounce pound cake, accurate horoscope, and a tech dividend stock. So why is that an oxymoron? Well, there's another quote that I like here I picked up recently, and now I'm going to use it without giving it a proper reference. I'm not sure who came up with this. I've seen variations of it. Profits are an opinion. Cash is a fact. And how true that is when you're analyzing a firm. So when a business has lots of positive operating cash flows, that means the business generates money. You can do something with that money. You can either use it to retire debt, you can return that cash to your shareholders in the form of dividends or share buybacks. But for tech companies, we want them to use the cash to generate more profits. And the example that I'll give you is this, the marketing machine example. So here at Nanalyze, we're in our growth phase, and we have a stellar growth marketing professional that's guiding us as we move towards growing our business. And the way it works is like this. So we take the cash that the business generates, and then we use it to purchase ads. And if we're able to purchase an ad for $1 and we're able to get $3 in subscription money from that dollar on ad spend, that's called return on ad spend, then that's a money-making machine, and you start pouring cash into that. So that's an example of how we would use cash to generate more profits instead of giving it back to shareholders. Now, let's talk a little bit about separating the wheat from the chaff. So when you look at technology companies that pay dividends, there's quite a few. So NVIDIA pays a dividend, for example. Microsoft pays a dividend. Tesla, they could pay a dividend, but what does paying that dividend mean? Any dividend at any time? Where do we even start when we're looking for quality tech companies that pay dividends? Well, you start by looking at track records of growth because, as we said, a dividend's a dividend, doesn't mean anything. But if you show that you're able to consistently increase your dividends over time, that track record means something. If you're a tech firm, that means you're growing revenues, you're growing dividends. So dividend champions, and we've talked a lot about these recently, come to the table with a 25-year consecutive growth track record. At least they've increased their dividend 25 years in a row. Tech changes fast, so we want larger companies with longer track records that show their ability to stay relevant. So this is our Quantigence strategy. We've developed it. We just released a new report for this. We developed it over the past several decades, and each sector is broken out. So you have 11 sectors. One of those is information technology. These are the firms that ended up in there. So our universe, we take all known dividend champions. We filter on market cap. We only want firms with $11.4 billion market cap or higher. So that's a floating cutoff that we use. In the future, we may have a Quantigence small cap universe, but for now, we want the larger firms. As I said, they're more likely to survive and thrive over time. And here they are. So you have Roper Industries, ADP, IBM, and John Henry. Now, everybody probably has heard of IBM. ADP perhaps, so we're going to touch on each of these briefly, but they do HR software more or less. Roper Industries we're going to focus more on today because it's a really interesting business. And there's John Henry that operates in the financial services sector. Now, I wanted to talk about a couple things real quick. When you look at Roper here and you see their yield, we're actually penalizing them. So the way this works is that we look at these 7 factors and then we calculate what's called a Q score, so we're able to rank stocks. We simply ranked all the stocks in information technology sector here that are included on this table. You can see, so Roper right now has a 0.55% yield, but they're growing it very fast at 16% per year. So even then, at that growth rate, in a decade, it's not going to be all that great. So a 0.55% yield growing at 16% will be about 2.43%. That's not very much, right? But if it's a 1% yield growing at 16%, in a decade, you'll have about 4.4% yield on cost. That's what your money's actually yielding. And that's not terribly bad. And then you can do the math from there. But the point is that for some firms without a very high yield, you're going to have to wait a while for that income to grow. So let's talk about Jack Henry. Here you can see, and I tried to pull one slide from each of these firms to kind of describe what they do, and this was the best one that I could find for Jack Henry. And they provide this platform, payments, and some other bits for smaller banks, and for credit unions. So you can see here they've captured a fair amount of market share in those areas. It's a small company. I think the market cap somewhere around $12 billion. It also has a low Q score. This wouldn't be a firm that we would be interested in. But next up the list is IBM. Now, everybody's probably familiar with that brand, and I'm going to link to a presentation that we did on IBM recently, and we go through what the company does and the Ginny Rometty years and all that. So we'll put a link to that. I'm not going to get much into it except to say that they've been able to increase their dividend for quite a while, and they're in the middle of trying to turn their business around because they just stagnated for such a long period of time. That brings us to ADP. You know, a slide like this really tells you everything. And, you know, we cover tech stocks here at Nanalyze, and I really have to change my mindset when we switch over to dividend growth investing, because we don't care that much what this business does. We care that they've raised their dividend for 48 years in a row. And then you look at this forecast for 2024, and you see 6 to 7% revenue growth, 10 to 12% earnings per share growth, which is where the dividend growth will come from. They have 1 million clients across the globe. 1 in 6 U.S. workers are paid on their platform. They process $3.1 trillion in annual payroll. 41 million workers paid. They have an excellent credit rating, AA there. This is a firm that's solid, and all we care about is seeing that increasing dividend check come by every quarter, and we're happy with that. Now, Roper Technologies is a firm that was a new entrant to our universe because we decided to start including all S&P 500 aristocrats. So prior to this change, we had excluded, I think, 4 or 5 names for reasons surrounding corporate events. And to make things easy, we simply said, well, we'll include all dividend aristocrats, provided that they meet our market cap cutoff and any other rules that we might have. I think that's probably the only one. This is a dividend aristocrat, which means they've, or champion, increased their dividend for 30 consecutive years. If you want to know the difference between an aristocrat and a champion, I'll put a link to a recent video we did on that topic. They seem to have successfully reinvented their business. It's more or less a portfolio of software businesses, a software conglomerate, if you will, and then you sprinkle that with some water and medical device exposure. So I really liked this slide from Roper. It talks about market-leading businesses in defensible niches, a decentralized operating environment, and process-driven capital deployment. And these are really buzzwords and fluff, but if you actually look at what those terms mean in practice, that's very attractive. And they talk here about having a high-performance culture, minimizing risk, keeping it simple, vertical and mission-critical solutions. These are the software bits they like to get their hands on. High customer value equals high gross margins. Talk about highly recurrent revenue, asset light. These are all great words. So this was taken from quite a verbose investor deck that they had, which kind of gets a bit too verbose. But there's some good bits in there, and this is what matters here. This is their portfolio of companies. So you can see here they've broken down these firms by revenue tier, and I highlighted one that's was totally made me think back to a long time ago. So iTrade Network. In my past life, I worked as a software engineer, and the last startup that I joined, I think I was employee 7 or 8, and we got our options. Everybody's all excited, and we were going to retire. This startup was called Amfire. A definite shout out to everybody that was ex-Amfire. Well, we built that business quite big, and we ended up merging with iTrade Network, and I think nobody that I know did overly well for a number of reasons. I mean, certainly we made some money, but it wasn't anything that was life-changing. But iTrade was then acquired by Roper, so I'm very familiar with the business that iTrade Network operates in, and essentially they do a hub-and-spoke model in the food service industry. It's very, very compelling. It's a great business, and you see here they have businesses across all different sorts of industries and applications. You see the application software, their healthcare, education, government contracting, legal, utilities, network software. That's the second category. Construction data, food supply chain. That's where we operated in. Freight matching, life insurance, media. And then tech-enabled products. They talk about here medical and water. So what this boils down to is this slide that shows their organic revenue growth versus their total revenue growth. So a lot of the growth for this business is coming from the acquisition of other companies. And if you were to be critical of this business, you'd say, well, organically, they're not able to grow that much. Well, they're also a collection of portfolios or a collection of technology software companies that are unrelated. So it's actually quite impressive, this blended growth that they're able to achieve. Now, there was a good comment on Seeking Alpha about Roper, and it said that they seem to be like Berkshire Hathaway, buying completely unrelated businesses that are only prized for their cash generation abilities. And they said keeping the business standalone means they can't take advantage of economies of scale. Yes and no. It seems like their business is to buy and sell companies as a unit, similar to a PE firm. Yeah, and it's actually, from our perspective, it seems attractive. And they make a good point here. They say software is a dangerous business with high rates of obsolescence. It's a mystery how they've done so well till now. Seems risky at first glance. Indeed, software is a dangerous business. But the other thing I think that the other way to look at Roper Industries is that they're able to keep the startup culture for smaller companies. I remember when we merged with iTrade Network, they brought in corporate shrinks to go through the management team and to vet everybody. You can imagine what that did to employee morale. And when Roper acquires a firm, they let them operate as they were, and they simply change shareholders. You don't want to interrupt a performance culture because that can create problems. But what you can do is you can spread best practices across your portfolio of SaaS firms, especially relating to SaaS. For example, you might be able to get cloud computing discounts because all SaaS firms will need cloud computing storage. Cybersecurity solutions, you may have them migrate off of whatever they're using onto the platform that you use across your portfolio of firms. Same thing with infrastructure solutions. Vendor consolidation is probably likely to happen across Roper's portfolio. And when their companies run into problems or when there's a talent gap, then they're able to fill that. So we kind of saw this as a good thing that they were keeping all these silos and sort of managing from a distance, found that to be very compelling. Now, getting back to information technology firms and investing in them, the approach that we took to dividend growth investing is we invested in 30 stocks across all 11 industries, not equally, but when it came to tech, we wanted to pick a few names, and a fair disclosure, we drank the Ramadi Kool-Aid. This would have been well over a decade ago. And as I said, our goal was to represent all industries, so we wanted to choose a few tech names. At the time, Roper wasn't an option. We chose ADP and IBM. Those are two firms that we're holding today. If we had to choose again today, we'd probably select Roper as the top dividend champion in technology. And that's not just because the Q score says so, but we find their business to be quite compelling. And as for the low yield, well, certainly you may want to consider letting the price cool off a bit before jumping in because it's going to take a while for that income to grow. But it will over time, and if the business is growing and it's a healthy business, then that income will take care of itself, especially if you don't need it right away. So just to conclude, maybe the biggest point to take away from this presentation, ask yourself why you want to hold a tech dividend stock, right? Going back to that comment about if it's a tech firm and they have a money-making machine, pour all that profit back into the money-making machine. Why are you giving it to me, right? So that's something you need to consider. And then this idea of lower yields versus high growth, what you see with Roper versus high yields and low growth, what you see with IBM. We need to make a decision there, right? Do you want that higher yield or do you want that prospect of growth? Larger companies are going to more effortlessly navigate crisis and keep increasing their dividends. That's important to note. It's not important to know much about the companies that you're investing in. When you're looking for pure play exposure to a theme, then definitely you want to see where that revenue is coming from. If we had to choose again, Roper might edge out IBM. So I'm going to put up another video here, a related video you might find of interest. Before you watch that, please click the Nanalyze logo on the right, subscribe to our channel. Thanks for taking the time to watch this today.